I do think this represents breakage. We saw cracks last year with in the autumn of last year, the treasury market was getting quite illiquid, and then of course the UK, the gilt market did break. They had to do some intervention. From there we saw basically a weaker dollar. There was kind of also the Treasury General Account was offsetting some of the Fed quantitative tightening, and so a lot of measures of domestic liquidity started trending sideways, and that kind of represented sort of a line in the sand. And in recent months, as we've kind of gotten back down closer to that sand, we did see this start to break. And so I do think in many ways, they've reached their point where it's hard to get much tighter than this.
Popular macro analyst and investment strategist Lyn Alden has given a detailed breakdown of the growing bank crisis caused by the contagion from the Silicon Valley Bank collapse. On Wednesday, 5 days after the collapse of the state-chartered commercial bank, Alden had an insightful discussion with Blockworks Macro's Jack Farley. During the interview, the macro analyst discussed the growing bank crisis, the part played by the U.S. Federal Reserve, and the growing risk of economic decline in the United States. Alden explained that the Federal Reserve and its relentless fight to bring down inflation contributed largely to the SVB collapse. However, she also pointed out some internal issues within the bank that sped up the unsightly outcome. She also discussed how the SVB and Signature Bank collapses might affect the growth of small regional banks going forward. According to the investment strategist, the closure of both banks will teach banks to be more careful with the diversification of assets and liquidity, while driving more of the existing liquidity toward larger banks. In addition, Alden also provided an answer to the popularly asked question, has the Federal Reserve broken the economy in its fight against inflation? We discuss all these and more in this video. Before we bring you Lyn Alden's interview, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos. Also, ensure you drop your comments and observations in the comments section. Thanks and enjoy the video.
So each banking crisis is different, and a lot of people I think fight the last war. So a lot of people when they hear banking crisis, they immediately think of 2008, whereas that was largely a credit event. Basically, banks made a lot of bad loans that were defaulting. In this context, it's not that bad loans are defaulting; it's that actually very, very safe securities were bought at high prices, low yields. And as we've entered a higher inflation, higher interest rate regime, many of them have unrealized losses, which for the most part, for like a big bank is fine because if you hold to maturity, you're going to get your money back. But if their deposit base is skittish because say they have a high percentage of not insured large business accounts, they can pull funding quickly and make a bank sell those securities at a loss. And for Silicon Valley Bank's case, their losses, were exceeding their capital because they managed risk poorly. But across the broader space, generally, when they increased rates this quickly, it put a lot of pressure on the existing asset bases of pretty much all banks, but especially skewing towards the small and the medium-sized banks, because when you have a liquidity problem in the banking system, it's not like liquidity can really leave the whole banking system quickly, but it can leave in any individual bank quickly, and so it can skew towards the larger banks and leave some of those small and medium sized ones dry. I think for most banks, solvency is less of a problem than the other two, and that's what makes it different in 2008. Liquidity and profitability kind of go hand in hand because if a bank wants to keep its deposits, one, it has to deposits have to have confidence in it, but then also if they want to avoid the long kind of drag of capital leaving them and going towards things like money markets, they have to increase their deposit rates, and that's where you enter the profitability problem. And so I would say for the long tail of small and medium banks, I would say it's both a liquidity problem and a profitability problem. Because those, one of the ways they can try to shore up their liquidity is by sacrificing some of their profitability. For larger banks, it's less of a liquidity issue because they have very very large and liquid securities books, diversified deposit base, and they now have access to the Fed's facility as well. So for them, it just becomes, I think, a potential question of profitability. If some of those maybe large regionals have to raise their deposit rates more, I think to the extent that it becomes a profitability problem will in large part depend on the Fed. If they really push forward with tightening, that can continue to suck money towards things like money markets and away from bank deposits, and then that therefore requires banks to raise their deposit rates at a quicker rate. Whereas if the Fed eases off, that gives banks more of a reprieve. I think that's a big concern, but I also think even if you're, basically even from a rational perspective, at this point, if you're a business, for example, if you're operating a bank account that's above the insurance limit, you generally do want to take precautious actions because you can't assume necessarily that FDIC is going to back every deposit, right? That it's something that at this stage seems somewhat likely, but you can't base business decisions on that assumption. So you have to assume a somewhat adversarial mindset and say, okay, we want to either diversify accounts, use bigger accounts, sweep extra funds into money markets. You want to take defensive actions, and none of that is particularly good for the small and the medium-sized banks. And so, I would obviously advise people against making panic decisions or emotional decisions, but you do want to take rational defensive decisions. And based on the current incentive structure they've set up, that inclined people towards larger banks, and towards money markets. There's also, I mean, there are some like fintech companies that can kind of like manage your money for you. So it kind of like puts it out into multiple other banks. So you can kind of like have a large amount that is like FDIC insured because it's spread out. There are solutions like that that could benefit. But overall, it's not a great environment for small banks to operate in, and small banks, because they're less liquid on average. They have larger loan books and less securities books. They have less use out of that new Fed facility compared to, say, the very large regionals, for example. So I would continue to be somewhat concerned about small bank profitability, and even if deposits are insured, there's still disruption if you have, say, one bank account with a small bank and then they have liquidity problems. Um, Obviously that can impair your business, even if it's just on a temporary basis. And so there are a lot of incentives for businesses to gravitate towards what they view as the most stable banks.
Over the past few days, several analysts and top investors have explained that big banks will be the only victor of the crisis, and this has already started to play out. According to recent reports, nervous bank customers are rushing to the safety of big banks, following fears that their bank could become the next victim of the banking crisis contagion. As a result of the panic and scrambling, Bank of America, Wells Fargo, and Citigroup have reported considerable increases in deposits since last Friday. On the other hand, small and regional banks are suffering deposit outflows. Earlier, Bloomberg reported that the Bank of America raked in over $15 billion in new deposits in only a few days. Citi has also reportedly had more new account openings across all categories of investors, including retail banking, wealth management, and small business lending. If this trend continues, it will only further strengthen the top banks, which already hold about half of the assets of the entire American banking sector. Let's get back to Lyn Alden's interview as she discusses how these collapses are signs of breakage caused by the Fed's incessant rate hikes in 2022.
Has something broken? Is this the turning point?
I do think this represents breakage. We saw cracks last year with, in the autumn of last year, the Treasury market was getting quite illiquid, and then of course the UK, the gilt market did break. They had to do some intervention. From there we saw basically a weaker dollar. There was kind of also the Treasury general account was offsetting some of the Fed quantitative tightening, so a lot of measures of domestic liquidity started trending sideways, and that kind of represented sort of a line in the sand. And in recent months, as we've kind of gotten back down closer to that sand, we did see this start to break. And so I do think in many ways, they've reached their point where it's hard to get much tighter than this. Now it's currently not hitting the Treasury market. So if they want to tighten further, they technically could. It would come with probably a lot of bank problems. And probably heighten the probability of recession. So it's not like it's an emergency where they have to stop right away. But I do think that for most practical purposes, any attempts to further, say, draw liquidity out of bank reserves is probably going to result in more usage of those types of liquidity facilities, and therefore offset some of their liquidity pull. And then whether or not they want to keep raising rates partially comes down to whether or not they want to really hurt that long tail of smaller and less liquid banks. And so I think that the end game was always going to be, when you have debt this high and when you have a financial repression scenario, is that inflation is going to run higher than rates for a long period of time. And the question always was, what is the path to get there? And what is the order of things breaking? And a lot of people are looking for credit events, which I still think there might be credit events, especially in say commercial real estate. But credit events are largely not the problem. It's about basically liquidity. Sovereign debt. That was like I said, the issue last year, and then this time it turned out in the banking system. So I do think they're at the point where it's harder to keep tightening beyond what they've already done, despite the fact that I think inflation is going to be a recurring problem. Maybe not a problem this year. We'll see what happens with ongoing energy and China reopening and things like that. But I do think it's probably going to be a recurring problem, and that it's really not something that monetary policy can address effectively, because it's more about the fiscal issues and the real world issues throughout the economy.
Meanwhile, the Fed sent another shockwave through the markets on Thursday when it added $297 billion in new lending assets to its balance sheet. You'll recall that the central bank has been aggressively trimming its balance sheet since last year to fight economic growth and high prices. As of last month, it had been able to trim its $9 billion balance sheet to $8.34 billion before the recent round of monetary easing to rescue the ailing banking sector. Do you think the central bank is finally ready to ease up on its aggressive campaign, which would give risk assets like Bitcoin and other cryptocurrencies room to flourish? Please drop your replies as well as comments on Lyn Alden's interview in the comments section below. Also, ensure you like this video, subscribe to the channel, and check out our other videos. Everything helps with the YouTube algorithm, so we can continue to bring you these videos. Thanks for watching.